seems like a worthwhile thing to try.
As the worst thing I can do is to, off the cuff, give you an answer to that question.
Not asking for an off-the-cuff
And,
answer.
and so what I'm going to do is go back to the desk. Well, I won't go back. My associates will go back to the desk and crunch a whole bunch more numbers. And that's a fair question, and I think it's something we'll look at.
Thank you.
That's great. Okay, good, Paul?
Yeah.
Harry?
Just a general question. These strategies, to what extent are they being proposed as diversifiers away from, as to help us to further diversify the portfolio? What we've seen in recent the most recent crisis that we went through, there was a lot of correlation, and we thought asset classes were diversified. They weren't. And so is that something for us to consider?
That's the only reason this is there. That's it, beginning and the end. It's all about diversification.
Okay, thanks. Can move on. No more questions for now, so. Oh, except for Tom. Go ahead, hang on. Go ahead.
So I guess at some point, as we zero in on a specific asset allocation, we would kind of see what a recommended portfolio of risk management positions would look like, or risk modifying positions would look like. I mean, there is fortunately, we're not a levered person, so the point that everything in extreme crisis, everything may correlate to one for a day is not the huge driver for us that it is for some other people. But I think that's going to make a large difference in understanding what the recommendation is. So that's going to be important to me to see sooner rather than later, I guess.
Because in the staff, in the write-up, we get the key considerations, right? The inclusion of the RMS, the infrastructure, home country bias, elimination, reduction of fixed income. I presume the next iteration will have more of a recommendation potentially on portfolio. Will we get that?
The other ones most of those are self-evident, like home country bias, we know what that means. I think the big question is what populates this RMS strategy? And I think we have got to work together to give that to you and do some modeling to answer Paul's question and come up with alternatives, because there's not a model. I mean, at the end of the day, this is not an asset class. It's a diversification strategy. And that's what it is. It's a strategy to get away from equity risk, which, as your staff has shown, is over 95% of the risk of the portfolio.
Okay, thank you. Stephen, or who's next? Stephen McCourt?
Great. We'll get Makita's presentation up on the screen. Great. I'm going to skip to slide 1,354. Start at the conclusions. How's that? My thumb's getting tired. Okay. I just wanted to give a brief review of the summaries here. They don't differ meaningfully, if at all, from Alan's description. And then I'm going to go back and walk through some of the nuances of the model so you understand them. The first thing I wanted to highlight is what we in PCA are presenting in this analysis are outputs of a model. To reiterate what Alan said, nobody knows what the future will hold. We create these models as a best guess estimate of what returns and volatilities may look like. So I would encourage you as trustees not to feel like you are constrained to follow the model point by point. And I'll highlight some important ways in which we already know the model doesn't reflect the real world. But it is as best a guide as we can have in making these types of big decisions. Second thing, the model is very flexible. So as we go through here, just be aware that we in PCA can model an infinite number and type of asset allocation models to show you how different mixes of asset classes are likely to impact the probabilities of risk and volatility in the future. We can look at different risk measurements. We can look at different economic and capital market risk factors and how they impact the current portfolio and alternative portfolios. We can look at how alternative asset allocation portfolios, alternative asset class portfolios impact the liquidity and cash flows of the system, how they impact management fees. So all of this is designed to be very flexible for you. The conclusions are that in terms of mean variance efficiency, there's really three things that the model points to that you should think seriously about this time around. The first, Alan mentioned, we've talked about, which is the use of the risk mitigation strategies as opposed to traditional fixed income allocations as risk mitigators in the portfolio. The model does tend to allocate assets to these strategies with assets coming from both U.S. equities and some from fixed income. The model encourages higher allocations to infrastructure. However, what I will highlight later is the model's only doing that because we've constrained it so that it cannot tell us that it wants more private equity or more real estate. So infrastructure is the only private market asset class that's allowed to float. So the message for you is that whatever flexibility you give the model, it will replace public equity allocations with private equity and real estate and infrastructure allocations. Private market assets tend to look more efficient on a mean variance basis. And then finally, as Alan mentioned, the model does point you towards investing more of your equity portfolio outside of the U.S. than you currently have. That, however, is a much smaller impact than the first two, which I'll go through. So with that, I'm going to start back on the beginning of this presentation. So the first thing I want to highlight is the identification of the policy portfolios. Over the last several meetings, we've been provided through a process with asset class risk return and correlation assumptions to use in this model. We've been provided with a set of constraints for the model. But even with those constraints, there's a limitless number of portfolios that we can choose to model and show you risk characteristics of. In identifying which portfolios to show you, we wanted to be systematic in that process and practical as well. So first of all, we chose 5 portfolios to model with reasonably distinct risk and return characteristics. These policy portfolios have expected levels of standard deviation between 10.8% and 15%. And the associated expected return of each of those portfolios ranges from a low of 7% to a high of 7.6%. Incidentally, based on the constraints that we placed on the model, there is no mix of asset classes that would allow you to get an expected return higher than 7.6%. Within that spread, we favored mean variance efficient portfolios, meaning that we're looking at portfolios that, for the most part, maximize the level of return per unit of risk, or said differently, minimize the unit of risk, each unit of risk per level of expected return. But we did have some additional considerations. First of all, we wanted to acknowledge that you have a very large $190 billion portfolio today that's managed in a specific way. For you to make any changes to your asset allocation, you will necessarily have implementation costs involved in any changes. And those costs could be transaction costs in terms of selling and buying securities. They also relate to implementation costs related to needing to expand investment staff in certain areas. And the way we addressed that modest bias towards the status quo is requiring that a 10 basis point increase in expected return would be necessary to justify a 5 percentage point departure from your current target allocation. So said another way, the model, our policy portfolios favor the status quo unless the model can tell us there's a meaningful advantage to changing.
Stephen, can I have Harry jump in here?
Yep.
Steve, it's probably me, Mr. McCourt, but it's late in the day. But I think that last point for me is probably relatively important. You said you're a modest bias towards the current status quo. And for us to deviate from that, can you just reiterate that point? And
Yeah, so
for
what we
my
wanted to
understanding?
acknowledge here is any change to a policy portfolio is going to create costs. And those costs are usually not incorporated into the asset allocation process. And so the way we incorporated those costs were in selecting the policy portfolios. We required the policy portfolios to have a 10 basis point improvement of expected return to justify a 5 percentage point departure from any current asset allocation. So as an example, we would only select a policy portfolio that had a 5% lower U.S. equity allocation if that portfolio had a 10 basis point higher expected return, or conversely, 10 basis points less than expected risk.
So in that example that you're giving, the 5% change in global equity, right?
Right.
That would be the range. Currently, there's a range that staff has, the percentage
Right.
of the overall portfolio. So it would be a 5% reduction. So it would go from 52 to 47, or 47 to 52, as opposed to 52 to 57.
Correct. Correct.
Thank you.
The other selection criteria we included was management fees. Some asset classes have higher fees than other asset classes, and models tend to love high-fee asset classes. So in order to mitigate that a bit, we only chose policy portfolios that involved a 10 basis point improvement in expected return or reduction in expected risk for every 2 basis point increase in the aggregate fund's management fee. So even though we look at these expected returns on a net of fee basis, we want to be sensitive to the fact that we know for 100%, with 100% certainty that you're going to pay more fees in the future with these asset classes. You can't be 100% sure they're going to return what the model is saying. So we have a preference for asset classes that are lower fee. The policy portfolios that we modeled are shown on the screen above. They're called policy A, B, C, D, and E, and then the current policy. As I mentioned before, they range from more conservative than your current portfolio to more aggressively structured. And as staff mentioned in their review, we look at a variety of summary risk statistics, including the standard deviation, but also expected tail loss, which is the average loss in a 10th percentile outcome, and the 10th percentile funded status ratio for each of these portfolios. On slide 15, I just want to highlight the summary statistics in graphical form for the policy portfolios, your current portfolio, and the model. This chart shows what's known in the industry as an efficient frontier. The efficient frontier is the frontier of portfolios that represent a wide variety of asset class mixes that have the highest level of risk per unit of return, given the inputs to the model. The very smooth line that is highest in this chart is the unconstrained frontier. So if you had placed no constraints on your portfolio, that would be the asset allocation frontier that the model would point you to. The middle line, where most of the policy portfolios reside on, is the constrained efficient frontier. That represents the optimal portfolios given the constraints that you placed upon the model. The line beneath it represents the frontier if you chose not to allow the model to redirect you to risk mitigating strategies. So what that shows you is that without the ability to move into risk mitigating strategies, the frontier is less efficient on a mean variance basis. Constraints are worthwhile. Incidentally, if you do not constrain this model and you wanted the same expected return as you have today, the model will tell you to invest 57% in private equity and 30% in trend-following hedge funds. So there's very practical reasons why a unconstrained frontier doesn't make a whole lot of sense in the real world, but we wanted to show the unconstrained frontier regardless. I wanted to talk a little bit about the sensitivity analysis of risk factors because this came up before. There's four main risk factors we look at when stress testing portfolios. The first is GDP growth surprise. Second is inflation surprise. Third is interest rate surprise. And fourth is the level of systemic risk. The first three factors are surprise factors, and I just want to spend a quick second on this. What tends to move markets is not the level of GDP growth or the level of interest rates or the level of inflation. It's to what extent the level of GDP growth, inflation, or interest rate differ from existing market expectations. So when we look at the sensitivity of your portfolio to these various factors, we're looking at how much your portfolio would move if actual GDP growth, inflation, and interest rates were higher or lower than existing market expectations. A couple of items to take from this chart. The vast majority, as you've heard already from staff and from PCA, of the risk that is in your portfolio today and will probably always be in your portfolio, given the required return, is GDP growth risk and systemic risk. Those are the big equity risks in the global market. Inflationary risk and interest rate risks are risks for sure, but they are very small risks relative to the risk of a global recession. What I will note is except for the most volatile policy portfolios we modeled, the other policy portfolios do mitigate slightly the exposure that your existing portfolio would have to GDP growth and systemic risk. So on page 22, I want to highlight a couple of other pieces of data. For most of the remainder of our analysis, we simply modeled the current policy versus policy C, which is a policy that has a slightly higher expected return than your current portfolio and a slightly lower risk, so it's more efficient. It's easier to look at one alternative policy portfolio relative to the others. And as I mentioned before, 90% or more of the increased efficiency of the policy portfolios is simply a function of the policy portfolios, including the risk mitigating strategies and including higher allocations to infrastructure. So the output from policy C would be very similar to the output from the other policy portfolios. Page 22 shows you that policy C has less tail risk than your existing portfolio. Over the course of the next 10 years, based on the inputs from the model, we would estimate that there's a 5% likelihood of your current portfolio losing money. Policy C, which has the risk mitigating strategies and the higher levels of private markets, would have a 2% probability. So you're not eliminating the risk, to Alan's point, but you are at the margin moderating it. Likewise, when you look at the probabilities of producing a return below zero and a return higher than 7.5%, the policy portfolios that include those new allocations do improve the general outlook for the allocation. With the probability of achieving a 7.5%, what return was important to know is that a portfolio would need to have an expected return of 7.5% or more in order to have a greater than 50% chance of achieving a 7.5% return over long periods of time. So a lot of the lower returning portfolios that have less risk associated with them protect you better from short-term risk with a very high degree of certainty. They also have a much lower probability of achieving a 7.5% return over the full 30-year period that we modeled. The final thing I want to highlight is just some economic sensitivity that we did to show you how the portfolios behave under a variety of economic environments. And without going into the mathematics of it, I'll just go to my summary page. We use the sensitivity analysis to GDP growth, interest rates, inflation, and currency values, the US dollar, to model how different asset classes are likely to behave in the context of changing economic conditions. And to get to some of our discussion earlier, to a certain extent, the decisions you make on asset allocation only have a marginal difference on the return outcome of your portfolio. What's really going to drive the success or failure of the portfolio in the long term is the economic environment that you exist under. So what we looked at in modeling this, and these are graphs showing the funded status of the system under a variety of economic environments, given 10th, 20th, 50th, 80th, and 90th percentile return probabilities. And what we want to see is ideally asset allocation policies that improve your funded position if bad stuff happens, and you're probably willing to give up a little bit on the upside of funded status if really good stuff happens. And that's the case here. So in the base case, as Alan mentioned, your current portfolio in the 50th percentile or the median outcome gets you nearly 100% funded. Policy C, which we're modeling here, gets you slightly better funded, but to a very similar position. But if you have return outcomes at the 80th or 90th percentile, the return outcomes of policy C start to become more meaningfully improved relative to the current portfolio. If you look at the middle left chart, we have a global stagnation scenario, and this is a scenario where we model GDP growth being much lower than the market currently expects over the next 30 years. As a consequence of GDP growth being lower, we can very reasonably expect that inflation will be lower and interest rates will be lower as well. And you can see that the probabilities of achieving a fully funded status are lower, but policy C improves your probability still. The scenarios that improve, the economic scenarios that improve your position are scenarios that include higher rates of inflation than we're currently seeing, and higher levels of interest rates than we currently have, and a weakening U.S. dollar. So the three scenarios on the right are scenarios where, regardless of the asset allocation policy you choose, your position will be improved relative to the base case scenario. I do just want to highlight in conclusion that we did a 5-year liquidity analysis on each of these asset allocation policies, looking at the cash flows that you'll be required to have over the next 5 years. None of the policy portfolios that we modeled give us any concern that even in a worst-case capital market environment, you would have cash flow issues, at least in the next 5 years. And finally, on the management fees, as I alluded to before, and to Paul's point in the previous discussion, the downside of risk mitigation strategies and to higher private markets, for that matter, is you increase your management fees. And we know with 100% certainty that higher management fees, all else being equal, translate to lower returns. We expect higher risk-adjusted returns from risk mitigating strategies and private market strategies, but we can't guarantee that. So we want to at least acknowledge through this process that if you do increase allocations to these areas, the management fees that CalSTRS pay would go up. But it's pretty easy to estimate by how much as we look at this. I think I'll finish there.
Yep. Thanks, David. So, Chris, where do we? Oh, yeah, sure. My question's gonna be, where do we go from here? So go ahead and Paul.
Just one question on Steve's presentation, and I, I think many of the questions that we might have had for what you presented, we probably asked of Alan, because the two of you gave largely fairly similar presentations. I think you showed us a slightly different way there towards the end of looking at the downside risks, which I appreciated. But I guess my question has to do with sort of the feasibility of moving into these new portfolios. Just as I think it was Arena asked the question of, how quickly can we move into the risk mitigating strategies? I think you said that basically because of the constraints on real estate and private equity, that what happens is we just put a lot more into inflation sensitive, which is primarily infrastructure. But that seems to be an asset class that has been very slow to grow, not because of any failure on the part of our staff. It's an asset class that has just been slow to grow for a whole lot of institutional investors who've tried to add to it, and we can sit here and debate why. I have my opinions about that, which are that we're probably not going to see it grow very much over the future. So I would find it useful to see something that either explains why we're going to add to that class, and I know later in this meeting we're going to talk about the idea that the inflation-sensitive asset class is not just infrastructure, even though to date it's been probably primarily infrastructure. I'm a big fan of investing in infrastructure. I just don't think we're going to get there. So I think it would be good to see another constraint that limits the size of that asset class, because I think it's unrealistic that we're going to get up to 5 or 10% anytime soon.
Yeah,
Just on that, working with staff, the inflation-sensitive caps infrastructure at 3%. So it was not given the opportunity to maximize the exposure to infrastructure, recognizing the difficulty of deploying the assets.
But inflation-sensitive
my understanding is
was a lot higher.
Right.
6%
but
total,
only-
right?
Only no more than 30% of it could go to infrastructure. The other parts have greater ability to access.
But just to
And is
confuse
that-
the heck out of you,
And those are new, but those would mostly be new asset classes for us, right? I mean, the ones that we're going to be adding in when we consider the.
Yes.
So is it reasonable? I don't know, but is it reasonable to assume that those can be increased quickly?
Yes, but not to do it thoughtfully, it's going to happen over time and it's going to be incremental. You're not going to get to those targets for a number of years.
and Paul, just to confuse you, the PCA and Makita had slightly different constraints on their models. So our model was actually allowed to go up to 5% infrastructure, and that was the outcomes that you saw from our model. So it would have a difference if we constrained that to 2%.
Can I just clarify something, because I'm a little confused by these comments? So our long-term target in inflation sensitive is 6%, correct? Or that has been our long-term target, is that right? And then what I understood is the constraints in the models was 3% to infrastructure, is that correct? But your model is larger than that? So PCA's model was maxed out 3% for infrastructure, your model was 5%. Was that just kind of, you chose different? Constraints, is that-
The way Makita modeled it, we had separate risk and return assumptions for infrastructure and TIPS, and therefore we had separate constraints for infrastructure and TIPS, each at 5%.
Okay, that's helpful. So then the other part of inflation sensitive that's not infrastructure, are we looking at other, can you give us examples of what other things we're looking at? Is that,
Sure,
it's like commodities or?
it's described in one of the tables in the back of our report, but I believe,
I
it,
just did it, there's
and
so many
staff,
tables.
staff can correct me if I'm wrong, I'm just off the top of my head,
That's
it's timber, ag, commodities, tips, and infrastructure. Those
Too bad
5.
Dana's not here right
Yeah,
now.
we miss Dana.
Timber, we'll make sure we text her that information. Are you okay, Paul? Is that Joy?
Yeah, thank you. Yeah, I also have a question that's sort of related to implementation. I think Chris has pointed out, and the staff did as well, that one of the key assumptions in some of the proposed allocations is that we would eliminate or move away from the home country bias. And Stephen, I think you talked about even an overweight in emerging markets. How would our overlay of the ESG factors work? If trying to also overweight in that category, I just wanted comments about implementation.
Yeah, I think it would be a challenge and something for staff to think hard about. The overweight, the constraint to emerging markets in our model was only a very slight overweight to the market cap index. So the model was it was mostly pointing you to move to a neutral position from your current position. But to Chris's comments earlier, even going to a neutral position, staff would have to do a lot of work in figuring out how to have that allocation in the context of the ESG principles presently.
So I don't know if that's something that when we, if there's any more sort of comments or insight, Chris, that you or the team could share as we continue to look at this.
Yeah, no, one of the challenges with emerging markets is just managers have capacity limits. There aren't many managers that focus in on the ESG issues that we care about. So a lot of the things that are being recommended here are challenged to implement, and that would be the last stage. We would come back once you pick an asset allocation. We would come back to you with an implementation plan, and we would point out the areas that will be tougher to implement quicker. Obviously, the emerging markets, we have a group of managers. Some have limits on how much we can give them more. And then we just recently finished an RFP we have a few managers. A pool that we would draw on and fund up. What I was pointing out earlier was that in the emerging markets, the ESG factors become an increasing sensitivity and focus and likely to land more on our lap.
Good question, Joy. Any other questions from committee members? Seeing none.
We're at an impasse. The next step in the process would be, and I think what we're looking for, I guess I'm going to speak for the board, or I again channel Dr. Yetman a little bit, is looking for hard recommendations from the two consultants on specific portfolios. I think they want to know your view. Should they keep doing it with and without the RMS class? Do you want to express an opinion about whether to consider that or limit that or keep your options open? But clearly the board would like you guys to come back with a more clear, I like C and I like G and H and zero it in.
Let me get Harry and Arena, and then we can.
So my preference would be along the lines of what Mr. Ailman just stated. Mm-hmm. I would really welcome some clear recommendations from our consultants within a range of possibilities that a prudent person would adopt an allocation, a plus or minus. And I think that would help us really narrow in on what we need to do. Because I think it's, 1 is an education, 2, it's a decision, 3, it's a vote, 4, it's implementation. Mm-hmm. At this pace, I think we've done the education, we've done it well, we've done it the CalSTRS way over several periods of time. I think it would be very helpful for me, I don't know where the rest of the board is to get a little clearer direction from our consultants as to recommendations that you think would be prudent, plus or minus within this range, these are the possibilities.
Lorena?
I just didn't want to lose sight of the question that Paul asked earlier, because I think that's pretty key to making the decision, is what the downside is of not doing the RMS. So I just want to make sure that that would be part of what would
Yes.
come back to us.
Right, we've directed the consultants to come back in the November meeting, right, to provide that information? Or do we want that information in the next, how do we want the information, I guess? When do we want it? I'm asking, like Paul, the rest of the investment committee.
So
Do we want it?
I'll propose something.
Sure.
Is that Makita and PCA come up with their favorite portfolio. I think that if we do that narrows it down to two, coming one from each consultant. I think what you'll find is that they both have some form of RMS in them, right? With the appropriate analysis that you're asking for, that'll be part of the analysis. And I think what you'd find is that there will be common themes in those portfolios, and there will be some marginal differences that you'll have to wrestle with, but you'll get pretty darn far down the path on that.
Yeah, I think the key term there, Neil, is marginal differences. There'll be some marginal
I'll give
differences.
Paul.
The one thing
We
I'm
can live
gonna
with those.
add, Sharon, I think we need to ask both consultants is to identify what clearly goes in the RMS portfolio. And what we'll do is come back with a staff recommendation of which way we think you ought to go. That will give you an action point.
Let me get Paul in here so we make sure his question and his voice is heard. Go ahead, Paul.
So as I look at what the two of you have already done, the big difference is whether you include RMS or not. That if you were to take out all of the approaches that did not include RMS, and you looked at them all, the differences are so minor, especially given the uncertainty as to what is actually going to happen, that the differences are rounding error. And likewise, if you looked at all the ones that had RMS in it, because if we put RMS in, our favored ones are our ones with RMS. Again, there's almost no difference. So I think the real question for us isn't which of the options with RMS in them, because your favored proposals will have RMS in them. You've already told us that. Because then there's very little difference. The real question for us is do we want to rely on RMS or not? That's right. And so it seems to me that what we should see is we should see one with RMS, one without RMS from each of you. It might even be great if the two of you could agree on what they are, so we have one RMS and one non-RMS. And then if we could spend some time talking about the risks and rewards of RMS.
That sounded like a motion.
That sounded like a motion.
It's a
I'll
motion if-
second it for discussion purposes.
So it's been moved and seconded. Any discussion? I guess clarification that, that in that we will have more color around what RMS strategies are. We'll talk more about what those are, what those look like, examples of those. Any other discussion?
Just want to make sure that Mr. King got what the motion was so that everyone's clear.
Lamont kind of looks unsure, so maybe Paul, if you could reiterate the motion, Paul, can you?
Sorry,
Well,
Mr. King.
That's all right. Or Harry, or you
Or
guys
Harry,
can
who
help each other.
seconded it. He
Well,
can-
well,
he
I
can
believe-
say that.
The last person who
It
touched
was
it has
that
to go.
both PCA and Makita would come to us with two recommendations each, so a total of 4. Each would have a
One with an RMS. strategy,
RMS
one
in it
without.
and one without. So we'd get 2 RMS approaches and 2 non, one from each. So
Did you get that, Lamont?
I have it, yes.
Okay,
Two quick comments.
sure,
very
go ahead.
quickly,
Yes,
Madam
that's okay.
Chair.
We're in discussion
Number
mode
one,
now, so feel free.
I think if you would be so kind as to include in the motion that you instruct the staff and the consultants to get together, so if we can only give you 2 as opposed to 4, because I think that would be easier. Hopefully we can work out our differences, because they are minor. Whether or not they're rounding errors, I'm not going to go that far, but they probably are. And the other one is that in October, you're going to be having a discussion on investment beliefs. And I believe as part of that discussion, this whole issue of RMS is a key consideration as part of what you believe as an institution. So I think that the timing of that is excellent.
So Lamont, do you get that as part of the motion, is to make sure that staff and consultants work collaboratively together, and that in a perfect world, we maybe come down with one RMS, one non-RMS example portfolio, in a perfect world. All right, we good? All right, so we need to vote on the motion. All those in favor say aye.
Aye.
Opposed? Abstentions? Great, we're so directed. Thanks so much for your hard work on that. Thank you, everyone. Everyone okay? Can we keep moving forward? Anyone need a break? Okay. All right. I'm like,
Does anybody need a
Lamont,
break?
let's go to item 9, the approval of the minutes. I'm just gonna try and prioritize items because I know it's 4:30 and I'm watching everyone, so I wanna make sure we. So approval of the minutes from July 9th. I'd entertain them, okay? Is there a second? Okay, it's been moved and seconded. All those in favor say aye.
Aye.
Opposed? Abstentions?
Aye.
So did you get that? Nora, okay, great. So we have approved minutes from July 9th. Let's go ahead into our semi-annual reports, number 11. I haven't forgotten item 7, we'll get to that, but item 11, which is Mr. Emkin. Gosh, you just get so much airtime today. Look at
And
you.
you've earlier in the day gotten a lot of information on recent stuff from Mr. Aylman, so, and this is dated. This is as of 6:30, but I'm going to hit a couple of slides. Start, please, on INV 140. There are 2 tables. One compares your performance versus your policy benchmark, and the other versus median fund. And what it shows in recent periods, you've either equaled or beat your policy index, which is a good thing. Over longer periods, you slightly trail, and that was in large part because of the impact of the real estate portfolio's performance during the financial crisis. But over all periods, you beat your peers. And for a fund of your size to consistently beat your peers, your staff deserves a lot of credit. Mr. Aylman dealt with risk and referenced our risk report, so I'm not going to be redundant there, but I would urge you to go to INV 149. There's a thing there called VIX, which is a sentiment of uncertainty in the equity market, and it was really low for a really long time, and it spiked dramatically. And in fact, over the last year, it's tripled at points. And so there's a lot more uncertainty in the marketplace. If you would go to 158, and I know you've had a long day, but I think this is really crucial. 158 gives you the returns over various periods for all of the major asset classes. And what I want to underscore is the difference between the returns of U.S. equities versus non-U.S. and emerging market equities. So if you look at 5 years, in the last 5 years, U.S. equities outperformed non-dollar equities by over 9% a year. So that's 1.09 to the 5th power. So that's like over 60%, 70%. And versus the emerging markets for 5 years, it's 13% per year. So that's 1.13 to the 5th power. It's a big number. The recommendations on going global, in fact, recognize there's a valuation issue here and that the U.S. markets look expensive relative to the foreign markets. So that's consistent with what's happened in the capital markets. And it's just to show that there's a consistency between the performance report and the asset allocation recommendations, that these things really do get integrated. Please go to 160. There's a table on the bottom that shows the changes in market value over time. The change was relatively small. What that change doesn't show is that $1 billion a month is going out the door. So the fact that just you kept even in a lackluster capital market when that much money going out is a testament. But that's, once again, one of the challenges you have to face in asset allocation is you have a huge demand for capital. And particularly in the near term, until the increased contributions kick in, it's very, very important, and that's why we emphasize the downside. Last page to go into, please go to 163. This is what we call an attribution. And what it does, it attempts to measure where value is added in the portfolio. And what I would point you to is for the 1 year period at the total fund, the biggest value added was from your equity real estate and your private equity. And in fact, that's in total dollars. Keep in mind that they have much lower allocations. And so, in fact, if you want to know, and once again, this goes back to strategic asset allocation, why are we recommending that you continue those asset classes and max out on them? It's because, in fact, they've added the most value to the portfolio over this period. Once again, it's integrating the performance reports and the strategic allocation and the assumptions. It all holds together. Happy to answer any questions. It's been a long day. Thank you.
I will not go as fast as Mr. Hamilton just did, but I will start you on INV 245. And there, do I have a slide? I'm going to breeze right past INV 245 anyway, just talking about the funding and remind the board that your denominator, as you've experienced recently, can move very quickly. Right now, when we looked at you at March 31st, you were 12.5% of the total plan. You're now 13.5% based on as of the August 31st numbers. And you will, great, thank you. The 23.9 billion March 31st value was the 12.5. You're now at August 31st, you were 13.5, and the denominator could take us to any number. What we would just point out to you is that all of that volatility will most likely leave you well within your range of 9 to 15% real estate. So at this point, we would not recommend that there be any actions taken to adjust for the shifts in the denominator. Returns, all looking very encouraging. You'll note that the dark blue line, the first dark blue line is your return. On a net of fee basis, the center line is the NFI Odyssey, which is all of the open-ended commingled funds, core real estate, net of fees, and the final bar, green bar, is your benchmark, which reflects the various benchmarks used over the last few years. The 3-year return, you'll note, now incorporates the Odyssey being your benchmark for a full 3-year period. As we roll in new quarters of the newly adopted benchmark, you'll see that that'll be more and more consistent with market. Actually very happy with your performance, and on the next page, I'll really specify why that is the case. These are the investments, the dark blue line reflect the investments your staff has made since 2008, 2009 market correction, and you can see how well they have outperformed both your benchmark and the market. When we look back at these returns, what we are seeing is the impact of investments made at the peak of the market, and we've spoken quite a bit about how those legacy investments will continue to impact you. If your high return investment that was supposed to achieve a 13 is modeled in your objective as a 13 and is never going to achieve anything more than a 9 because of the market cycle in which it was purchased, it will continue to drag your performance down. So this is the number I really want the board to focus on. This is the page, not only because they're better numbers, but also because it reflects that your staff has been doing what you asked them to do, and it's been providing you with very good results. I will highlight for you in the first quarter of 2015, you'll notice that your 1 quarter return is down relative to the industry. We do expect that to continue to moderate. You've done a lot of realizing of gains. realizing a value by moving value-created assets into your core stable portfolio, and a lot of different strategies in reducing risk and volatility, increasing your income. And so when all of those strategies start to hit their plateau, we will see that moderation. We would expect it to occur. We've been expecting the 3.2 to moderate down to a 2%. I've been sitting here for the last year at least telling you that, and we've been wrong for the last year. We were wrong for 3 years at the last market cycle, but we still continue to caution all boards that we do expect there to be some leveling off of returns going forward, and you cannot expect another 5 years of 19.3% from your real estate portfolio. Just to assure the board that you are in compliance with all of the restrictions, our criteria, strategic limits, your loan-to-value restrictions, everything within your portfolio is now well within the ranges that you've established. The projections for your portfolio for the periods ending March 31st, taking you out to 2018, will show you that you're just going to be increasing over time in your core exposure, decreasing your non-core exposure. It is this slide on INV 249 that I do want to focus on in closed session, and talk to you about how that might be impacting what you would be telegraphing both to the market and to your staff, and the things that the board should be looking at. But other than those comments, if there's any questions, I'd be happy to answer them.
There were 2 slides I wanted to highlight that I said were the most frightening slides in the entire packet.
Great.
I know, sorry. I didn't warn you. Can you go to your page 10? Is that in here? There, stop.
There.
So, boy, it's hard to see on the screen, but the upper right-hand side, so this is INV 251. I guess for the audience's sake, this is cap rates. Those little squiggly lines represent cap rates on the different sub-asset classes within real estate. Think of that as the opposite of purchasing price. So the lower it goes, the more you're paying. And you can see that in some cases, your real estate prices are basically up where they were your forward-looking return. Maybe that's another way to think about it. Think about it as if you buy today, here's your forward-looking return. You can see how low they are. They're almost as low as they were in 07 in some cases, but all the sub-asset classes. So the real estate market is really tight, especially in the major gateway cities. As we've discussed with you, we're not buying a lot in here. We're selling. I don't know that those prices are going to change because there's a lot of foreign money coming in, Asia and Europe. But we just know, you've heard me say it, buy high, sell low is the wrong way to go. And that's what's happening here. So we want to buy low and sell high, but right now prices are high. So it's a simple concept, but it's hard to get right.
Absolutely. We're seeing
So I
all
only
of
had one
this.
of the 2 slides.
You only have one.
Oh, good.
The other one's
Oh,
mine.
you're off the hook. Thanks, Michaelin. Appreciate it. All right.